podcast with Investing Education Academy. Now, we've all been bleeding together. We've all gotten beat up. It's been a very emotional last 6-7 months in the stock market, and we're in it together. So one thing I can say about us is we have not stopped showing up for you all. So another thing I should say is if you have questions, if you have something you want to ask, this is your opportunity. We can't make you do it, but we're doing our part in showing up. With that being said, today we're going to give a real world example of why valuations and profits actually matter when you're investing in the stock market. We've preached this ever since we started. You're going to see why today. Leon's going to tell you why we chose it, why I do a little housekeeping.
Yeah, so this is everybody knows right now the market, like Brent said, everyone's hurting. Market's not good. We've been saying for the past 6-7 months. This is no longer 2020, no longer 2021, and we've been saying get out. We beat a dead horse on getting out of high valuation, non-profitable companies, and moving into profitable companies with lower valuations. And a lot of people have heeded that word, some haven't, and the ones who have not have paid a horrible price in their portfolios. But we want to show today an actual because we say all the time, right? Get out of this, get out of that. But we're going to show actual factual facts and data on why.
Not factual facts.
Factual facts. Yeah.
Hold on, hey, Lee, before you go too far into that, I do want to also state that, again, since you all have started hearing us go live, we've been pretty consistent on understanding with the high valuation market that we were in. Even when we were still enjoying the unrealistic returns that came with it, we have continuously said this is abnormal. You can go back to listen in 2020. We said this is beautiful, but this is not normal, and you should not get used to it.
Right.
And I'm not saying that as a, oh, we told you so. I'm saying it as a please listen to the future things that we talk about, because we aren't guessing. And this isn't, again, it's not just a tug on our shoulders or pop your collar moment. It's us trying to really help you understand this is your moment. Like, you can ask us questions, you can listen to the content, you can go back to your portfolio. Leon and I, honestly, we can just do this inside of our community, our paid community. We choose to do this live because we want to, have a good effect on the people in our ecosystem. But if you don't understand something, or if you're like, you know what, can you all revisit that point? We won't know unless you ask. If you're listening to the podcast, you're running on a treadmill right now, and you're thinking, well, what do we do if we're listening to this? You can go to IEApodcast.com, drop a comment. We'll get to it as we can. But, of course, what else can you do? You can become an IEA member. And so you can always go to IEAmembers.com and become part of our inner community. But still, use this information. Share it right now. Some of you all, the slide we're going to show, you're going to want to see it. And if you're listening to the podcast, we'll explain what you're hearing during this live.
Yeah. So so everything Brent said was factual, right on point. But kind of getting back to the issue at hand is the market. It's not fun. It's not enjoyable. It's painful. We get it, as Brent said. We said back in 2020, 2021, as Brent said, this is not normal. Don't get used to this. The markets, if you were in the market prior to COVID, 2018, 17, 18, 19, we're getting back to that market. And in that market, valuations matter, profits matter. The COVID market, 2020, 2021, nothing mattered. Like, everything just went up, right? I mean, literally, you literally could throw a dart at something and you made 20, 30% blindly. Those days are over. Now, of course, there'll be anomalies. There'll be IPOs where they're up 200%, and you'll have some stocks. I'm sure we'll have a bit of, like today, GameStop, the stock that started the meme frenzy, was up 26% today. No news, nothing really behind it, just that whole meme fever. So, we're still going to have fits and starts and craziness like that. But going back, the 2020, 2021 markets, most likely over. We won't see that type of run again, a run for no reason, which really what those were. But so going back to, we want to physically show you why this is important and why going forward, the type of stocks you actually want to start, because before, we all want to do fun and sexy, right? We want to do the new IPOs. We want to do the things that had high volatility, that were running up, and it worked for 2 years, right? We were in a market that the world had never seen. We were in a pandemic fueled market with the cost of money, interest rates at zero, right? So everything worked. But now we're going back to the real world. We're going back to pre-COVID days, when the market, like I said, profits and valuation matter. So Brent, you can throw up the slide when you get a sec. So we're going to show you the huge, huge difference in non-profitable high valuation versus profitable lower valuation, and also that pays a dividend. So Brent, can you zoom in once? Yeah, that's cool. Yeah. Okay, so what we have on the screen here is it's a slide. On the left-hand side, we have high valuation non-profitable stocks. On the right-hand side, we have low valuation profitable stocks with dividends, right? So we're going to go through kind of the difference. So on high valuation, the 5 stocks we have are Square, and they're just the symbols. Square, SQ, Unity, I believe it's Unity Software, ticker symbol U, Rivian, IRVN, Joint Corporation, JYNT, and InMode, INMD. Those are the tickers, and those are the companies. Now, Square, and this is through the first week of May. So this is a couple weeks old, but nothing's really happened much in a couple weeks. So through the first week of May of this year, Square is down 40%, Unity Software was down 65%, Rivian was down 42%, Joint Corporation was down 74%, and InMode was down 65%, for an average loss for this year of 57.2% average loss on those 5 companies through the first week of May. Huge loss. So literally, that portfolio lost over half, almost 60% of its value in just 4 or 5 months.
Yeah, and a bunch of these were new IPOs at that. So you start looking at the fact that many of these were, and the reason why I bring up that they were IPOs is because
only one, Rivian and Unity were IPOs in the last like year or two. Yeah. Yep.
And so the reason why we bring that up is we've heard so many times, especially from new investors, how they're drooling and salivating to get into an IPO. Ooh, if I can just get into IPO, the world would be right. IPOs are not the holy grail. They are. We've said it. If you want to know when we said it, we did a whole podcast on the overwhelming failure rate of most IPOs in the United States. The ones that you never hear about. I mean, you're talking about hundreds of IPOs that hit every year, and most people walking around who are aware of the stock market only can probably name 2 or 4, anywhere between 2 and 4. That's all they can name. And you're talking about hundreds that IPO because hundreds of them fail. And so, with that being said, I just wanted to just kind of help you have clear eyes when you're looking at this. And if you're running right now, lifting weights, whatever you're doing, listening to the podcast, stop thinking that IPOs are going to be a golden ticket to untold riches. They are not.
Yep. We did a podcast, I think it was in 2020. It's 2020, 2021.
It was 21. It was 21.
21, yeah, that we showed the data, we ran the data, and IPOs, I think it's 3 to 5 years after an IPO, the majority of those stocks are actually down below their IPO price. So like Brent said, if you run up in there thinking, I'm gonna go get this IPO and make all this money, IPOs are generally, I'm saying generally, not all, generally, because you can have some winners. Generally, IPOs are bad investments in the relatively short term. For us, the minimum for us is 3 years. So 3 to 5 years for us, we consider that to be kind of short term.
So also with the 3 to 5 years, understand we are in very unique times. So some of you all are like, oh, well, you all always say that, but what about now? We're not idiots. Like, there's a time and a place to change your strategy slightly. And also, what we're talking about today is one of the reasons Leon and I changed our portfolios, and we helped a lot of people inside the community change their portfolios before all this happened. So my apologies, Leon.
Yeah, no, yeah. And so what was I lost my train of thought.
So you were saying like the average the valuations were high. They weren't profitable companies, and you were saying overall the average loss was 57.2%.
So on the left hand side we have again Square, Unity Software, Rivian, Joint Corporation, InMode. The average loss of those 5 stocks through May of this year, 57.2% average loss. So almost 60% down on your money if you own that portfolio in just 4 or 5 months. Yeah. Huge. I mean, that's devastating, and a lot of people right now are feeling it. I mean, they don't own this particular portfolio, but a lot of portfolios are down 30, 40, 50, 60%. Now, we can go to the right side of this card. So remember, those on the left, the ones I just went through, Square, Unity, Rivian, Joint Corporation, InMode, are all high valuation and or non-profitable stocks. I mean, they have no profits and or their valuation is was just catastrophic. What is the word?
Catastrophic.
In the stratosphere. That's what I'm trying to say. In the stratosphere the last 2 years. So remember, average loss on those 57.2% through May of this year. Now we're going to go on the other side, low valuation, profitable companies that pay a dividend as well. So the 5 companies we have are Bristol Myers Squibb, Nike, NASDAQ, the NASDAQ market site, JP Morgan, and Advance Auto Parts. So through May of this year, Bristol Myers was actually up. I'm going to say it again because this is rare for this year. Bristol Myers was actually up 13% through May of this year. It also pays a very, very juicy 3.46% dividend. So it was up 13% and it pays over 3% dividend through May of this year. Nike was down 30%. It pays a 0.74% dividend, so a little less than 1% dividend. The NASDAQ was down 24%. It pays a 1.09% dividend. JP Morgan, the largest bank in the US, was down 19%. It pays a 2.70% dividend. And then finally, Advance Auto Parts was down 6%, and it pays a 1.7% dividend. Now, through May of this year, remember, the other stocks through May of this year, they were the high valuation, non-profitable, through May of this year were down 57.2%, 57.2% loss for this year, through May of this year. These other stocks I just named, the low valuation, profitable with dividend, were only down 13.2% average loss through May of this year. That is a 340% difference in those losses. So the losses on the high valuation, non-profitable, their loss percentage was 340% more than the low valuation, profitable that pay a dividend. Huge disparity, right? Huge disparity. Again, 13.2% loss, average loss on low valuation, pays a dividend, has profits, versus 57% loss on high valuation, no profits. Huge difference. Now, the other portion of that, remember, I went through and I named the low valuation profitable. They also pay a dividend. So the average dividend paid on those stocks was 1.94% average dividend, right? So you add that in, or you subtract that from the, or actually add that into the loss, and the net loss for the profitable companies that pay a dividend was only 11.26% net loss for this year. So again, I'm gonna contrast that with the high valuation non-profitable. Through May of this year, those were down 57.2% through May of this year. The profitable with a dividend, including the dividend, were only down 11.26% through this year. That is an over 400% difference. That is a massive difference in your profit and loss in your account. And this is why it's very, very important going forward. And then, so I want to make another point is that through like the last 2 years, I mean, Brent and I included, I mean, we're not immune from this either. Everyone was going after, and for good reason, right? Like everyone was going after kind of the high valuation, the high valuation, high volatility stocks, right? The ones on the left-hand side, Square, Unity, Rivian, Joint Corporation, InMode, they fit in those, right? A lot of those stocks have been beaten down in the early days of COVID. They move fast. A lot of people defaulted to those, especially new people that are in the market that were never in the market before. Going forward, on the right side of this chart, where it's Bristol Myers, Nike, NASDAQ, JP Morgan, and Advance Auto Parts, none of those are sexy. None of those are high volatile, but those are where you want. Those are the first place you want to look now when you're buying stocks. Notice again, they're low volatility. Their losses relative to the high volatility stocks are way less, and then they also pay a dividend. That dividend is huge. That dividend takes your losses on the low valuation from 13.2% loss down to 11.26% loss. In percentage terms, that's a huge difference. That's 2% on 13, which is a huge change. So the point we're really trying to make here is that the reason we were saying get out of high valuation, not profitable, is right here in not black and white, but right here in white and orange, right? 60%, we'll just say effectively 60% loss on high valuation, non-profitable versus only 11% for profitable, lower valuation and pays a dividend. Like you can survive years. Well, I mean, nobody wants to do it. You can survive years. You can survive years of losing 11% per year. Nobody wants to do it, but your account can survive. You cannot survive if your account loses 60% per year. You're at zero after a year and a half, right? You've lost all your money. So this is why we're saying, again, you really want to focus on low valuation, profitable companies, and preferably if they pay a dividend, that makes it all the better. Because again, we show the example here that a dividend takes your loss from 13.2 down to 11.2 once that dividend is factored in.
And this is also why you should be part of an investing community or having a good advisor, because some of these advisors are horrible. But have a good advisor. You need to stay in touch with people during these times. Like what's the sentiment, what's changing, what's staying the same, where are the opportunities in this market, because there are some amazing opportunities. There are discounts all throughout the market right now. I had somebody call and they were interested in doing like $500,000 into the market, and this is like, okay, they're very wealthy and they understand that the market's on sale. And so, you have to pick well in these environments, but you also have to abandon some of the kind of cowboy mentality that you had in 2021. We have continuously, and I'm saying it again, we have said, and we will continue to say, we knew we were playing cowboy and we stopped it last year. If you are part of the community, you would have stopped with us. So for everybody who has been part of this, we know it hurts. We hurt too, but there is absolutely an opportunity in what's happening right now in the stock market. Also, too, for those of you all who are interested in joining IAA, we really suggest you do it now. The market is going to be going through a rough period. Personally, I predict 2 years, and during that time frame, I'm still going to invest. So let's be clear, but my strategy will change. It already has changed. It's just going to stay more kind of where it is now. And you need to be part of the community so you can figure out where your strategy needs to change as well. So with that being said, we owe you all two things.
Hold on. I was going to make one last point. If you noticed on the left-hand side, so basically the slide, what am I trying to say? What I'm trying to say is we're not pumping a bunch of BS sunshine here, right? We're showing you, and we made this point before, right? Because again, this is my pet peeve of people online that talk like everything's fine. We made the point before. We said the point in this market is to lose less, not to make money, right? I heard it's Leon Cooperman. He's a big hedge fund guy, old cat. He said those who lose less win in these type markets, and that's true. And it sounds crazy to say, "Oh, you lost money, you're winning." Well, again, if you look at this chart, wouldn't you rather have 11% loss versus a 57% loss, right? So in this market, if you're sitting in cash, that's a position too. But if you're going to be invested, you want to invest in things that will limit your losses. We're not trying to make money here. We're trying to limit our losses and set ourselves up for the next run higher. Like Brent said, it is painful. I mean, we're going through it too. But the stocks on the right-hand side of this chart, Bristol Myers, Nike, NASDAQ, JP Morgan, Advanced Auto Parts, none of them are sexy. None of them are really volatile, but they will make you money and they will lose you less money, which is more important. They will lose you less money in a market like this. And of course, they pay the dividend. So I would hope that everyone defaults to the stocks on the right-hand side of the chart versus the left-hand side. The left-hand side was 2020, 2021 going forward. And I also want to say that doesn't mean you shouldn't pick some of the more risky, more stocks with more volatility, because that's you can get some high returns with that. But you don't want that to be your default. For a lot of us, that was our default the last 2 years, going into the high valuation, really volatile stocks. You want to move away from that. You want to go to kind of a bit boring that pays a dividend. Dividends, remember, are paid out of a company's profits. If a company can pay a dividend, that means they're on sound. Well, let me take a step back. companies that pay dividend, companies that pay, I know, companies that
dividends
pay
from profits.
Dividend. Yes, that's the word. Dividends. Okay, dividends typically. Good point. Typically come from profits. Some companies do borrow to pay the dividends. That's very dangerous. But if a company is paying a dividend anywhere from 4 to 5% or less, I mean, do your research, see where that dividend is coming from. But typically, if a dividend is 4 to 5% or less, it's most likely coming out of their profits. So companies that pay dividends that come from profits are on very sound financial footing, and as you saw from the slide, will lose you less money in down markets, and will cushion that loss because they pay a dividend.
Yep, agreed. So we owe you all two things. During the time period, Leon and I always say, we're going to pick two stocks for you. And when looking at them, we want to look at what makes the most sense for this time being. Somebody challenged us not that long ago to run back through our stocks and see.
Jessica. It was Jessica.
It was Jessica? Okay, Jessica, thank you for that. And see which ones will we have still held on to, which ones will we have dumped. And I think that's a very important question. I'm glad we were asked that, because although we tell you all what our current picks are, we don't tell you necessarily, if you're not in our community, you won't know when we sell them. And so it's not that every stock that we picked is a stock we're holding into infinity and beyond. So just understand, you really should consider, going into the membership platform if you haven't logged in a while, and just revisiting that section, because it was quite eye-opening. And when Leon and I looked at our first month of picks, we thought it was going to be a bloodbath, and it was not.
No. And I mean, we picked things that were down like 20-30%. We were like, these things could drop 60%. But the fact that these quality companies were down so much, we're like, yo, we gotta basically bottom fish. And it paid off huge over the last 2 years. But those days are over. That's what we're saying. Those days are over. And what Brent's referring to is we did an ask an expert 2 weeks ago. So if you're in the membership platform, just if you're Insider or Panther, you can search the Ask an Expert section and find last week. But we actually went through, like Brent said, our first month, which was April of 2020, and we went through our first set of picks for that month. And like I said, it was very eye-opening. The stuff that we picked, the stuff that we would keep, because we went through the stuff that we picked, the stuff why we picked it, and will we keep it? Will we pick it today, or will we keep it from before? And it was like Brent said, it was really eye-opening. The change. I mean, the way the market has changed the last 2 years, and the mindset of the market has changed the last 2 years. It was a good one. So if you're inside,
Leon and I didn't agree on everything that we would keep or sell. Mm-hmm. And we defended our positions like right there on the spot. So I thought it was fun. Yeah. But again, if you are a member and you haven't logged, really my point is to those IEA members out there who haven't logged into the platform in a while, log in. It's a lot of new stuff, and look around, talk to some of your fellow members. They are posting and asking some pretty good questions. So with that being said, we owe you all two things, two stock picks. And I will pick my stock, and I'm going to put it in the platform. And Leon's going to pick his, and one of the other. One of us will put it in the Facebook group. One of us will put ours into the community. You'll never know which is which. But anyway, everybody, thank you so much. If you're on the treadmill, please get back to it. If you're doing your bench pressing, go ahead and knock that out. If you're just have us on the TV watching us, thank you for supporting us. And also, go over to YouTube and subscribe to our channel. It's growing. We're trying to get more people aware of the information that needs to be communicated, not just somebody slide across the hood of a luxury car saying everything's fine, you just need to invest with me. That's not accurate. No. So, with that being said, everybody, thank you so much for being with us, and we'll see you next Wednesday, 9 p.m. on the Investing Education Academy.